Hi, really nice to have you here again. Today we are going to talk about backtesting trading strategies with historical data. And if you don't know this already, it's very important to know what are the weaknesses and the strengths of your strategy. So if you don't know this concept yet at all, this is the video you should watch. Let's go and take a look. First of all, please do remember that we don't provide any investment advice and all the material is made available for educational and marketing purposes only. And please remember to subscribe to the channel. That would be a great help. Thank you. Backtesting is a crucial step in the development and evaluation of your trading strategies. It allows you to simulate the strategies using historical data to assess how well they would have performed in the past. And by doing so, you have several key benefits. Let's take a look at those. These benefits include performance evaluation, risk management assessment, strategy refinement, confidence building, decision making, and strategy selection. So obviously you want to know, if we talk about the point one, you want to know how well the strategy performs when the market is moving higher, lower, or sideways. Typically, a strategy that does well in a momentum market, i.e. trending market, does very poorly in a sideways market, and vice versa. If you have a mean reversion strategy that makes money in a range, it usually just makes losses in a trending market. Then number two, risk management is always the key in whatever we do, and trading systems are no exception. When you do backtesting, you understand how you need to change your risk management sort of procedures in the strategy or the rules in the strategy so that the drawdowns remain manageable, so that the risk-reward ratio of the strategy is good or acceptable. And then, because every strategy development process is a kind of feedback loop where you have an idea, you test it, you get feedback from the market, and then you implement the changes needed to make the strategy better. So you get this strategy refinement through the backtesting process. And then obviously confidence building, because every strategy has drawdown periods. Every strategy has good times and bad times. Therefore, you need to have confidence in your strategy when the times are not so good. When the market is kind of not favoring your strategy, then you have to have the confidence to trade the strategy. And this confidence can be built only through historical backtesting. You need to understand the weaknesses of your strategy and also the strengths of your strategy. And then lastly, decision making and strategy selection. Once you've done with backtesting, then you can decide which of your strategies you are going to run. You might have 5 or 6 that work really well. So you just have to see which one of those strategies is worth running in certain market conditions. So what's needed to build a trading strategy? You need obviously the rules. When to buy, when to exit, when to sell, and when to buy back after going short. You need a testing software for automated backtesting. You will need a spreadsheet for records keeping if you're going to test manually. The idea is that you develop the strategy using in-sample data, which obviously involves quite a bit of testing to see how the strategy should be fine-tuned. And once it is ready for out-of-sample testing, then you test it with all data you have. You test it with in-sample and out-of-sample data. You want to compare these two data sets and the performance of the strategy in both of the data sets. And you want to see if there are consistent results in both samples. And obviously, you need a lot of coffee, a lot of patience, and a lot of excitement. If you're going to succeed in trading, you really have to love the process of studying, researching, and backtesting and then executing strategies. So, how do you backtest a trading strategy? The first option is to go for automated testing. For this, you need to learn to code. Maybe it's R programming or Python. These are both free. You can test free with those, but it just means that you have to learn to program. Alternatively, you can find a programmer and pay for it, but that's going to be obviously expensive. Then you need a specialized backtesting software if you're going to do this on your own without a programmer, and that again isn't a free option. But if you want to go free and you are ready to spend some time with your testing and strategy development, then I would say use TradingView or MT4, MT5 and go bar by bar or candle by candle and see how the strategy would have performed with the historical data. Then create the statistics, how well the buys and sells did, and you just write those statistics down in a spreadsheet. Then the third option is to use Excel or Google Sheets, and these are obviously free. I have a video on how you can backtest trading strategies using Excel formulas. So when you are creating a trading strategy, you need the basic components of the strategy, the entry and exit conditions and the risk management rules, but then you might want to add some additional filters, like volatility filter. You might have noticed that markets move higher or lower with either low volatility or high volatility. So you might want to have the volatility filter there, excluding periods of high volatility if your strategy performs the best during the periods of market moving higher with low volatility. Then the time of day might be another filter. You have noticed probably that Asian and European or American sessions are very different. So if you want to have low volatility, maybe included in your strategy, you might want to trade in the Asian markets, and then you might be more prone to creating a system that is trading sideways markets. But if you are focusing on high volatility directional market moves, then you might want to concentrate on the European-American overlap. And then one more filter, you might consider including a weekday filter, because Mondays are often low volatility days and then the volatility increases throughout the week. Sometimes Wednesdays are high volatility days and other times it's Fridays. So you just have to do your own research, and then once you understand the market you're dealing with, then you create these additional filters. So what statistics you should pay attention to? When it comes to returns, then you should really focus on at least these 5 statistics: overall profitability, average win, average loss, maximum win, maximum loss. Obviously, you want to know, if we look at the overall profitability first, you want to know how much the strategy has made over the test period. Say if you test the strategy for 10 years, it makes, say, 540% over those 10 years. That sounds good. Okay, it's pretty good. But then, what if the maximum win in terms of percentage of the over all the profits that the strategy makes? If the maximum win is like 200%, then a big chunk of your profits is explained one single trade, and therefore your strategy suddenly doesn't look that good at all. What about the average win and average loss? It's always better if your average win is 2 or 3 times your average loss. But even a lower figure is okay. Say 1.5 times the average loss is still okay. But the bigger the average win and smaller the average loss, the better. And then we have the maximum loss as the percentage of the overall losses. So if your strategy's overall losses are X, just for the simplicity of the sake, let's say it's X or 100. It's 100 units. And most of these losses are explained by, say, one trade or two trades. If, say, 70 units or 80 units of these losses are created in two single trades, then there's something wrong with the risk management system in your strategy. You are dealing with a strategy that can suddenly lose a lot of money, and that is not in your interest. It's not in your best interest to run a strategy like this. Then the drawdown statistics are obviously as also important. If your maximum drawdown, like I said earlier, if it's only say 20%, that's marvelous. But if your maximum drawdown in the testing phase is to the tune of 50 or 60%, then you might want to go back to the drawing board and decide how to improve the strategy so that the maximum drawdowns are smaller. Then the duration of drawdowns is important because obviously you want to know how quickly the strategy usually recovers from a drawdown. That's important for your own confidence, so that you have the confidence to trade the strategy. Average drawdown is a key component in calculating the risk-reward ratio of a trading system. It really provides the necessary context to compare the potential rewards of this strategy against the risks that come with it. So usually traders evaluate whether the potential gains do justify the level of risk they have to take when they are using the strategy. Recovery time helps you to assess the overall performance and robustness of your trading system. It sort of shorter recovery time suggests that the trading system has the potential to generate consistent returns and potential to recover quickly from losses. And then on the other hand, if your system has long recovery times, then it might indicate that the system is, or trading strategy is sensitive to market conditions or lacks the risk management measures that you really should have in place. Hey, it was really nice to have you here. I hope that you found the video helpful. Now you can go and study these topics, and if you have any questions, please feel free to email us. The email address is support@tomarkets.com. Take care. See you soon.